Hey, accounting students, this is your teacher Roy with a video lecture for our chapter number 10. If you remember back in chapter number 9, we were dealing with short term or current liabilities that have to be paid off within 1 year. But now we want to still borrow money, but pay it off beyond a year's time or over many years. Here, the topic is called long term liabilities. But before we take a look at some details for long-term liabilities, let's go back to some basics that we have covered over the semester. Here, all of you remember that the assets we own have to equal the liabilities we owe plus the owner's interest, so the equity or the shareholder equity in our company. So let's say that we want to expand our company. We want to move into a new state or a new country, maybe to buy out a competitor. That means our assets have to increase. And now, to keep in balance in this accounting equation, we either have to borrow the money or have more owners invest money into the company, to fund this increasing in assets. Although we know that if our company is profitable, under the equity section, there's a subsection or account called retained earnings, and that's the profits we're making, we're accumulating. And if we have enough, we want to distribute that to the shareholders as dividends, which we'll talk about in our last chapter, chapter 11. Or if we want to keep this profits, keep it in retained earnings, that'll help us fund possibly this growing assets here. But maybe that's not enough. We still may need to borrow. We still may need to have other stockholders invest in our company. Okay, so the emphasis here in chapter 10 is through borrowing and not through short term where we have to pay it back within a year's time, but over many years or long term. So let's take a look at the advantages of funding this increasing assets, either through borrowing or through selling more stock. Here are the advantages of borrowing money. Here they call it bond financing, selling bonds, is that we're not going to give up control of our business. Now, if you go back in the previous screen here, if you sell more stock, now you're giving up your you're reducing the control you have of your company. But if you get the money through borrowing, these creditors have less say in the operations of your company versus other shareholders. Yes, if you want to maintain control of your company, you want to borrow money versus selling more stock. Here, the next advantage is that, of course, borrowing money is not free. You're going to have to pay interest to the creditors, to the lenders. And in a way, that's good because now you get to deduct those interest expenses, reducing the taxes you have to pay. But if you have to pay more dividends to more shareholders here, the dividends you pay out of retained earnings, that's not a tax deduction versus an interest deduction here would reduce your profits and you pay less taxes. Dividends also reduce the retained earnings, but you cannot deduct that for tax purposes. Okay, so you can give interest through bonds or other borrowing an advantage because the interest you pay is tax deductible. And here it says that if your return on your equity, if your return on your assets is bigger than the interest you have to pay on your bonds, we learn in this chapter 10, it's called financial leverage. Let me go back to that accounting equation again. If the return on your assets, let's say, is 10% on whatever you own, the income, and you can borrow money at less than 10%, well, what I want to do is borrow as much as possible and buy more assets because I'm going to make a 1% difference here in profit, and that benefit goes to the equity owner. Let's take a look at the disadvantages here. Here it says that bonds require payments of the interest, we know that, but also when the bond matures, you have to pay back what you had borrowed, okay? Versus You don't have to pay dividends. You don't have to pay back the shareholders, but here it's required if you borrow money. This last disadvantage is really the opposite of this advantage here. Again, we call this financial leverage. And if you have lots of liabilities here that you have to pay interest and eventually when it matures, but the return, the profit on your assets goes down. That difference between what you got to pay the creditors and the earnings on those assets is to the detriment of the equity owners. Again, we call that financial leverage. When things are going good, it's good to borrow money and invest in your assets to the benefit of the owner. But if profitability is going to go down or even losses, you still got to pay that interest to the creditors and not enough earnings off the assets, probably the value of your equity is going to go down. Okay, so that's a disadvantage for financial leverage. Let's take a look at the amounts we have to deal with when we borrow money through selling or issuing bonds. So here's our business, a corporation, um, borrowing money by selling our bonds to investors. Another big type of entity that sells bonds is not corporations, but the government, the federal government, state governments, municipalities. A big way they raise money, in addition, of course, to charging us taxes, but for big projects, is to borrow money by issuing bonds. Even our university sells bonds to the public for big projects like constructing the dormitories on the Manoa campus or building classrooms. And they use, of course, their tuitions to help pay off the bonds and the interest. But here we're dealing with a corporation. Now, keep in mind that we're taking the point of view of a business that's selling the bonds, that's borrowing the monies. And we're not taking the point of view of the person buying the bonds, an investor. Now, you as an individual, maybe you're buying stocks, maybe you're buying stuff like Bitcoin, but a more conservative type of investments is to buy bonds, be it from a business or even from the government. Probably buying bonds from a government, the federal government, is the most risk-free type of investment because the government is not going to go out of business. All they have to do is just charge more taxes, right, to generate income. Whereas corporations, especially small startups, are very risky. They may not pay off their liabilities. Definitely, they may not pay off the owners because the creditors get first shot at the money, right? If they're going to bankrupt or or dissolve the company. Okay, so we're going to sell the bonds up front here, and eventually, at a certain date, you have to pay back when the bonds mature. Could be a couple years, could be decades, yeah. But in the meantime, every so many months or so many years, you have to pay the bondholders periodic interest. In the case of business bonds, typically the bond interest gets paid every 6 months. And then again, when it matures, you pay off the whole bond liability here. To calculate out the periodic interest payment, here's the formula. We take the bond par value or the stated value or contract value. That's what's written on the bond, typically in increments of $1,000. Then we multiply that by the contract interest rate, a percentage stated on the bond for one whole year's worth of interest. Then we multiply that by the time value. Typically, it's going to be 1 year or half a year. That's your time value. Okay, so principal par value times the interest rate, that annual percentage, times the time factor, typically 1 year or half a year, will give you the amount of interest you have to pay each one of these periods over here. Okay, let's move on to an example. Well, here's an example of a paper bond. You usually don't see this type of bonds anymore because everything is done electronically. But right on the bond, you would have a contract amount, a specific dollar amount that's going to be really the amount paid back to the bondholder when the bond matures. We're going to see maybe when they sell the bond, it's not going to be this dollar amount here, but it's going to be a different amount, bigger or smaller than the contract amount. But the contract amount is the amount the company has to pay back the investor when this bond matures. Then there's going to be a stated interest rate, so much interest on that contract amount per year or per annum. Okay. Again, typically you sell bonds in amounts of $1,000. So whenever you see one, that really means 1,000. And sometimes the minimum amount you buy, if you're an investor, is $5,000 worth of bonds at a time. And again, this paper bond, typically you don't see paper bonds anymore. Again, it's done electronically and really through a broker like Fidelity or Vanguard or TD Ameritrade. So once the bond is sold, again, if you're an investor and you want to buy bonds from IBM, here is the interest rate stated on the bond. Again, that would be right over here on if it was a paper bond, 4% per year. And the bond is not going to sell for 100% of its contract price, but here, because everybody else is paying a lower rate than what you're paying on your bond, this rate doesn't change, right? But everybody's paying a lower rate. People are willing to pay more than 100% of that $1,000 contract price. Or here, they would pay um, 3% more, yeah, for a bond because you're paying more interest than what everybody else is paying. But now, if the bond eventually matures, I guess this is 42 months from now, IBM only has to pay 100% of the contract price and not 103% that what it's selling for right now. Again, you're paying extra, this 3% more, because your bond is paying more interest per year than other bonds. So to get this same rate as everybody else is paying, you're willing to pay more for that bond. And again, this is not IBM selling the bond right now. Yeah, it's whatever in the hands of the investors willing to sell it to other investors right now. So let's take a look at the company issuing out the bonds and not really, again, an investor selling to another investor. And we're going to sell the bond at whatever is stated on the bond here at that contract or par value. So we're going to sell the bond at $1,000, $100,000. That's the par value. And again, that really this means that when the bond matures in 2 years from now, the company has to pay back the buyers of the bond that same $100,000 that we're going to get right now. And the interest rate on the bond is 8% per year, but the interest is going to be paid every 6 months. So on June 30th, you pay 4% of 100,000. At the end of the year, December 31st, you pay 4% of 100,000. So here on December 31st, the journal entry to record the selling of the bond, again, we use the word issuing the bond, is to collect the money, 100,000, and eventually you have to pay it back. So that's a liability payable, here called bonds payable, increasing the liability with a credit, increasing the cash asset with a debit. So let's take a look now at what happens on after 6 months, yeah, June 30th and December 31st, and the following June 30th and December 31st, yeah, before it matures. Here's the formula again to calculate out the interest. Principal, the amount that's on the contract, times the interest rate per year, and times our time factor. Not 1 year, but 6 months or half a year. So that means on June 30th, we have to pay $4,000 to the bondholders. So cash credit, reducing our cash asset. But you're not paying back that 100,000 you borrowed, right? That's going to be payable in 2 years. So here is the cost of borrowing money, an expense called bond interest expense. Expenses recorded with debit. So we do this also at December 31st and June 30th next year and December 31st next year. Yeah, 4 payments over 2 years. But now, at the end of the 2 year period, we gotta pay back whatever it says on the bond's face value or par value. So cash credit, here's the money going out. And now we don't owe the bond anymore, so we reduce the liability with a debit. Now, all of these journal entries we just saw is if the bond was initially sold for its par value of 100,000, meaning that the interest rate we're paying on the bond is the same as everybody else for comparable companies of our size, our risk factor. Okay, so this is what we had done. Our contract rate, that 8%, and everybody else here called market rate was paying 8%. So we're going to sell our bond for whatever it says on the bond, that $100,000 amount. But if everybody is paying more than you, market rate is bigger than our contract rate that's written on our bond, you won't be able to sell your bond at $100,000. To be able to raise money, you got to sell it for less than that par value, or here called a discount, yeah, below the par value. Or if the opposite situation, your rate on your bond is bigger than the rate everybody else is paying, you don't want to sell it at par like we did before because you can get extra than that 100,000. That extra is called a premium. In either case, selling it at more than par, selling it at less than par, the extra you get, the less than or below par you get, that's really a part of the interest you're paying the bondholder. So let's take a look at an example of selling a bond at less than its par value, or here at a discount. So the facts are we still have that same $100,000 par value. And again, the way to interpret par value is the amount you have to pay back the bondholder when the bond matures, and not necessarily how much you're going to get when you sell the bond. Here is your stated interest rate. You're paying 8% on that $100,000 per year. But you know what? Everybody else is paying more, 10%. So to be able to raise money, you won't be able to sell your bond at $100,000. You gotta sell it at a reduced or discounted rate. In our class, you probably, if we do sell at a discount, you'll probably be given this percentage. I believe in the appendix there may be a calculation you can use to determine how much you can get, or how they factor this 96.4% based upon your rate and the market rate. But in any case, we'll be given, in at least in our class, this this rate here, yeah, the issuance rate. In other words, we're going to sell the bond at $96,400, yeah, not the 100,000, or the difference here of $3,600. The difference is the discount you have to get charged to borrow money, because again, everybody's interest is paying higher than your interest rate. And when the bond matures, you don't pay back this $96,400. You pay back the full $100,000. And again, we're paying interest not every year, but every 6 months, yeah, for the next 2 years. So let's take a look at the journal entries. When you first issue the bond, the amount of cash you're collecting is this 96,400, yeah, that we saw being calculated over here. But when the bond has to be paid back, here's our liability, bond payable again, for the full Par value, the contract amount, $100,000. And to equalize the debit for cash and the credit for bond payable, we need more debits going to this new account called discount on that bond payable liability. We know bond payable is a liability account, but the discount on bond payable is the opposite of a liability here called a contra liability. And to know what we call the carrying value of the bond, you would combine these two amounts together. And we learned from chapter 2, when you combine debits and credits together, you never add them, you always take the difference. And right now, the difference is that amount of cash we got. But again, we call that the carrying value of the bond, 96,400. And as time gets closer to the maturity date, you know you're going to have to pay back the full $100,000. So what we're going to do is reduce this bond payable liability over the 2-year period. And the carrying value eventually will equal that par value that we have to pay back. In the meantime, there's going to be 4 interest payments, 2 per year for the next 2 years. And we got to calculate out the interest for each of those 6-month periods. Now, we need to take into account the discount because that's really more interest being incurred. Because again, here's the money we borrowed, 96,400. Here's the money we have to pay back, $100,000. And again, the interest every 6 months, right? We've learned that to be, again, the principal, 100,000, times the interest rate, 8% per year, times a half a year for 6 months, or $4,000 every 6 months, or 4 periods, right? 2 Junes and 2 Decembers, comes out to a total of $16,000 cash we have to pay out over the 2-year period. But also another cost of borrowing the money is the money that we didn't get, the 3,600 discount. So that's really more interest being incurred. So the total interest over the 2-year period is not 16,000, but $19,600. And if you divide that by the 4 periods, that means truly the interest for every 6 months is not $4,000 cash you have to spend every month, but another 900 for 1/4 of the discount that you have to pay back. This is again money that you didn't collect when you sold the bonds. Yeah. So every 6 months, here's the cash going out as interest payment, and another 900 of the discount being used up, or sometimes we use the word amortize. This calculation here, if you can believe it, is relatively simple, called a straight line method of amortizing the bond discount. If you go on to take an intermediate financial accounting class, you'll learn another method mentioned in one of the appendices at the end of our chapter called the effective method. You're not responsible for the appendices in our class. Again, if you want to learn the more detailed methods, you need to take the intermediate accounting classes. So we add up the 2 here, and again, the total is the interest for each 6 months. Yeah. And you're going to see the same entry at December and June next year, and December at the next year also. Yeah. So by the end of the 2-year period, we're reducing the discount amount all the way down to 0. Okay, here's the carrying value. That's 100,000 bond payable minus the discount equals the carrying value. Yeah, that's after 6 months. Then the next 6 months, reducing the discount and increasing the carrying value. Eventually, that discount goes down to 0, and the carrying value equals the par value of the bond. So that 100,000 is now at the end of the 2nd year is what you got to pay back, and not this amount you had borrowed. Let's go the other way now. You're going to sell your bond at more than the par value because your interest rate on the bond is higher than the interest rate everybody else is paying. So slightly different facts here. Same 100,000 par value. Your stated interest rate, look how high it is. You're paying 12%. And everybody else, the market, is paying only 10%. So when you sell your bond, you can get more than 100,000. Here, $3,600 more. You still have to pay your semi-annual interest. That's 10% times 100,000 times one half for 6 months. Yeah, and you do that every June and December for 2 years. And then when the bond matures in 2 years, you pay back not 103,600, but the par value of 100,000. So that 3,600 extra you got is really going to reduce the interest you incur, the cost of borrowing the money over the 2 year period. So we go through a similar calculation again. Yeah. Well, here's the initial sale. Look how much money you got, more than 100,000. But when the bond matures, the liability you pay off is not that amount, but only the face value or par value of 100,000. So the extra you got is not going to go into a discount account like we saw in the previous example that you debited, but now here a credit to equalize the debits and the credits goes into this new account called premium on bond payable. And just like the discount we saw, this premium is going to be reduced or amortized over the 2 years. So eventually the carrying value, combining these two together, will be the 100,000 that you have to pay back at the end of the 2 year period. The term they use, not commonly used, but here they call it adjunct, like next to the liability account. Yeah, credit you would add to get the carrying value. Okay. And this is how it shows up on the balance sheet. If this was a discount, you would be subtracting it to get the carrying value, but premiums you'd be adding. So, just like we saw before, principal times the interest rate times the half year factor. There's four of those payments, so total interest over the 2 years is 24,000. And because you're getting extra when you borrow the money that you don't have to pay back, here that premium is reducing the cost of borrowing money. So truly the interest you pay over the 4 year period is only 20,400. Divide that by the four payments, the interest comes out to 5,100 per every 6 months. Interest expense 5,100, yeah, every 6 months. But the amount of cash you're paying is that 6,000, yeah, the 6,000. And the difference is the amortizing of the premium, yeah, reducing the interest expense by 900. So you're doing this journal entry 4 times, yeah, for every 6 months. And then when the bond matures, the amount you pay back, let's go back here, is the 100,000 carrying value. Let's move on to the next topic here. When the bond matures, what do you do? Well, if you're paying back just the par value, simple, right? We saw this entry before. But how about if you want to buy back the bond, redeem the bond before it matures and it was sold at a premium or discount? So let's take a look at an example here. We're going to call back. That's what the term is called when you redeem the bond early, callable. You're going to buy back the $100,000 bond. But to be able to sell it in the first place, maybe if you have a call feature, you're going to have to pay extra here called a call premium of $3,000 more. Again, if you buy back the bond early. So that's the cash you see being credited here. And then you have to zero out the bond payable liability here for the face value that you recorded when you first sold the bond. And if there's still unamortized premium or unamortized discount, you got to get rid of that associated account. So in the case of a premium, you would debit. If there was a discount to zero it out, you would have to credit. And to equalize the debits and credits, you're just going to plug in an amount, here in this case, a credit. And just like revenue, yeah, this is a revenue account called a gain. We're actually making money by uh, calling or redeeming the bond early. But if you have to record more debits than credits to equalize this journal entry, the debit would be a loss, just like an expense. But in our case, we have revenue credit here. But keep in mind, you have to have this $103,000 cash to do this. Now, where is this money coming from? Sometimes what companies and even the government would do is sell more bonds to get this cash, especially if the interest rate on any new bonds to sell is lower than the bond they just paid off. Yeah, we call that a refund or refinancing of the bonds. Let's take a look at some borrowing again, but this time from a bank. Yeah, and here is not an investor but a lender, like a bank, and not a bond but a so-called note payable. And the interest rates and the par amount, the stated value, can vary depending on how much you want to borrow. Okay? So you borrow the money, and you're going to be paying periodic interest amounts over time. Most times monthly, sometimes um, semi-annually, and then you pay off the loan here. But instead of making one big repayment here, what you can do is spread off the repayment with your interest over the term every month or every so many months. In this case, they already figured out for you. You're going to borrow $60,000 from the bank and not just pay interest every month or every 6 months, but you're going to pay three payments over the next 3 years, which is both interest and also repayment of the loan. You can use interest tables here called annuities or present value tables, or you can use Microsoft Excel, and they have function formulas here called PV to calculate out this factor here. In any case, we're borrowing $60,000. You can see the money coming in and the liability, not note bond payable, but note payable being credited. And then instead of paying every 6 months or every month, here we're going to pay every year for the next 3 years, this amount right here. So part of this is interest and part of this is repayment of the note payable. So after these three payments for 3 years, the note payable will be zero. And any extra pay would be interest over the 3 year period. Again, it's all factored into this number right here. And if we do have a problem in our assignments, you'll be given this factor. So how does the journal entries look like for each of the 3 years? Yeah. So here's the amount of cash being paid. Here's the amount of cash being paid for the second payment and the third payment. But notice that the interest here goes down each year and the repayment of the note goes up each year. So if you take a look at the calculation of these amounts here, the 60,000 we borrowed times the interest rate. What is our interest rate here? 8% gives you this 4,800 interest for the first year. But you didn't pay 4,800. You paid $23,282. So the difference between these two amounts is paying back the note payable. So now the note payable after the first year has gone down. It was 60,000. Now it's only 41,518. So to calculate the interest for the second year, we take this new principal times 8%, and here's the interest for the second whole year. And again, what you paid is the same 23,282, and the difference between the interest and the payment is the payment on the note payable, reducing the balance. And here's the interest for the last year. and the rest of the payment is repayment of the remaining principal. So three equal payments equals the total you have to pay. So the excess of over the 60,000, the 9,846 is the interest paid over the year. And here you can see a little bit more detail, yeah? All the payments are the same, three payments, but the first payment has the biggest interest and the balance is payment on the loan. The second is less interest and more principal on the loan. And the third is the least interest and finishing off payment on the loan. So typically, this is how you would look at when you borrow money for a car loan or home mortgage. Initially, the first payment, almost the whole thing is interest, and very little would be the principal paying back. Yeah, but on the last payment, maybe in 5 years or 30 years, almost all of it is principal and very small sliver of interest. But every month or every year, basically it's the same payment. Okay, they call this an installment loan. Now, a mortgage is not a loan. A mortgage is just a feature of borrowing money. A mortgage is security to the lender. So, in the case of if you default on your loan, the lender can foreclose, can claim the property and sell it to help pay off your loan. Okay, that's what a mortgage is. And sometimes the borrower is called a mortgagor and the lender is called a mortgagee. It's just additional paperwork, yeah, in addition to the note payable liability. Some other terminology. A mortgage would be a secured loan, yeah? And if you borrow the money and the whole company assets is what's using it as security, they call that an unsecured loan. You're just a so-called general creditor, and you have to kind of stand in line in front of other creditors who are have claims on the assets of the company. Convertible loans mean that they can be converted from liability bonds, typically to stock, maybe common stock or preferred stock. We've seen the callable loan, yeah? The company has the right to buy back the, the bonds from the investor. Term means that there's a set time that the bond is going to mature. Zero means maybe a bond will be maturing over a period of time, maybe half in 5 years and another half in 10 years. Registered means you're registering the ownership with the company so they know who you are, the bond owner. Bearer bonds means whoever owns the paper is the owner. So it's kind of risky, yeah, if you lose the paper or someone steals it from you. Most times, again, you buy bonds not directly from a company, but through a broker. And the broker would be the registered owner on the behalf of the investor. Of course, at the end of our chapter, we have ratios, and here's one called debt to equity ratio. So, again, basically, what we're looking at is our accounting equation again assets. Now, who's funding the purchase of these assets? Are you borrowing the money, or is it being through investing and the profitability, equity? So, what we do is take the liability and put it in the numerator, and the equity and put it in the denominator. So that means now, in terms of assets, who's funding the assets more? If your ratio is more than one, looks like all of this is more than one here. Yeah, more than one. Here's less than one. That means you have more borrowing than investing through stockholders. This means it's a little bit more financially levered. And you can see the trend here. Yeah, both companies are getting more financially levered over time. Although I know currently these are kind of old numbers. Under Armour is not a company doing well. Nike is doing better. And you can see Nike is more financially levered during a period of profitability. If you can generate more profit on your assets than the interest you have to pay on your liabilities, you want to have a big debt to equity ratio because the benefit of that extra profitability over liabilities is going to go to the benefit of the owner. But just the opposite can happen if profitability goes down or if you suffer losses. that can really wipe out the equity of a company. Okay, so that's debt to equity ratio. So let's stop here. Let's make sure you do your smart book assignment, learn smart assignment, and homework, and prepare before you take the online quiz. Okay, I'll talk to you later.